So that's CNBC, which is a national news network, talking about the marketplace, a positive revision to GDP. But when we look at things like your financial plan, I like to look on the local level. No one better to help us with that than David Reyes, joining me here in studio. David, good to have you here.
Good to see you.
So happy belated Thanksgiving.
That's right, you too.
Yeah. So
it's been a long time.
Yeah, I know that Black Friday was a flop.
Yep.
I don't think Cyber Monday did too well.
Better. I think Black Friday was down about 11%, 14%. Cyber Monday was up. You know,
people don't shop as much. Does that have something to do with that?
I think online's been going up every year. You know, Cyber Monday. You know, people are more. What's easier to shop, Amazon or go to?
Hey, you're preaching to the choir. I'm a big online shopper.
Exactly. So, I think it has a lot to do with it. So it's hard. Retail sales numbers were actually weak. A little surprising.
Now, does that include online shopping as well?
Well, this is prior months. This is for October, November. So you know, it's not. I don't know if it's not yet priced in this oil reduction, this gas price reduction, which we'll talk a lot about today. Real important. There's a lot of side effects economically for the consumer that need to be discussed today.
Well, David hosts a radio show on KFNB on Sunday mornings. There's a chart that you have here that you've referenced on your radio show and ours. We'll flash it on the screen for everybody. Tell us what we're looking at.
Yeah, well, basically, this chart we have it's basically a historical chart. It's about 145-year chart since 1870. And there's only been 2 times, Craig, that we've been above 90% of the long-term trend, and that was in 2000. Okay, and we're currently there again. We had 29 days in a row where the market was actually above its what's called 5-day moving average. No, I don't want to be too technical, but that really means that the market's kind of floating in thin air, and that's the second highest level it's ever done that for, second longest time period it's ever done that for. It broke that yesterday when the market corrected a little bit. But the bottom line is that we're in a really straight up market, unprecedented. We have a lot of. What's happening is we've gotten rid of our QE, and now we have this world QE with Japan, now China, the Eurozone, and
that's helping our market.
It is, because it's causing less cheaper cost of goods, lower cost of borrowing, which stimulates business. We're still in a world economy. It's not real healthy, quite frankly. It's kind of like
we finally kind of got away from that crack addiction, as we've called it, on QE3, and now we're leaning on someone else's addiction here.
Well, exactly. It's spilling over to our markets, and that's okay in the short run, but in the end, you got to make a profit. And it can't just be about disinflation. We can't, if we continue on this path, we don't want to end up like Japan or like Europe, which are disinflationary economies. And oil is a big key factor with that we'll discuss. But the point is that that revision of GDP is real. Our economy, we are the prettiest girl in an ugly contest right now, right? And so we're not killing it, especially when you're talking about 6 years into an expansion. 3% GDP average growth is not on fire. You want to be in the 4, 5, 6% range when you have serious recovery.
But the market does have legs. So despite pulling off QE3, it seems like we got some legs here. Now, one of the things you've been commenting on quite a bit is the situation with oil and OPEC. We actually have a video here. Let's roll tape here, guys.
Feeling Tuesday evening when the Russians came in and out. They're not in OPEC, as we talked about, and the Russians delivered nothing in terms of adding to the cuts which were hoped for from the OPEC grouping in order to get the price back up again. So then it came to the meeting on Thursday, and there had been some pretty tense talks between the Iranians and Venezuelans and Saudis beforehand. The Venezuelans thought they got a deal to have some form of production cut. I'm pretty sure of that. Mr. Ramirez stormed out of the meeting. He was the first minister to go afterwards as well. And basically what it came down to in the end, that from Dakota to Riyadh, every producer wants less oversupply on the market. They want the price back up again. They want $100 per barrel, but nobody was prepared to do it. So it fell very firmly on the shoulders of Mr. Naimi and Saudi Arabia. And Saudi Arabia was saying, no, we are not cutting. We did not create this problem as well. Very interesting as well. I spoke to the new OPEC president, someone we have a pretty good relationship with, Dezani Alison Madueka. She's a Nigerian who, incidentally, they used to export 1 million barrels a day to the United States. They don't export 1 single barrel of Bonnie Light now to the US because of the shale revolution. So I spoke to her. She's the new president, and she said it's not just OPEC who have got to share the burden. Listen in.
Going forward, that's very clear. We're all in this together, and it is not just OPEC. In fact, OPEC produces.
So what say you?
This is a very complicated topic, but a very important one.
If I'm watching, why should I care?
I'm going to tell you why you should
Okay.
care. So what's happened, oil's dropped 35% this year since June. Okay, that's a huge drop.
Okay.
It dropped 10% in one day. We got
Wow.
oil hovering around, I mean, this is major. You don't have a positive economy with low oil prices. Think about it. When you have growth in the economy, you have inflation, don't you? You have higher demand.
Okay.
So that is the divergence we're having right now. Oil going down like this precipitously is really great for the consumer, but for markets, it's actually not very good. What's happening is the Saudis are trying to, OPEC decided not to intervene and to cut production. They're doing that on purpose because they want to drop the cost of oil, because they want to squeeze out our fracking that we do that really cost around $85 a barrel is the number I hear to break even for profits. So what that means to people is what's happened is you've had a lot of negative reaction to oil service stocks, to a lot of energy stocks, and a lot of those borrow money in the form of high yield bonds. So you ask me, how does it affect you out there listening, watching? Is that if you own high yield bonds, about 20% of all high yield bonds are tied to oil companies. So oil companies' profits do what when oil prices go down? They fall. Okay, one oil company, I think it was Continental, went down 20% in one day. Okay, so the bottom line is if you own high yield bonds, in particular, be very, very careful because there's a lot of oil company stocks that borrow money at this, and high yield bonds are a nice way of saying junk bonds. Okay, they're not investment
typically
grade.
when people put their money into
default
bonds,
rates.
they're thinking safer investments,
right.
and you've been pretty cautious about bonds recently. One thing I'd really encourage our viewers today, David is a brilliant financial advisor. He offers a second opinion. Now, typically there's a cost of doing something like this, but he'll do it for you as a viewer here today for free. If you reach out to him online, you go to reyesplan.com. I highly encourage you, just get a review. Make sure that you don't have any exposure in your financial plan. So we've talked a lot about the market and even a political issue a bit with what's happening with oil. Certainly confusing, like you said, when you see oil prices down, it tends to, you would feel like a good thing. But when the market goes up or down, left or right, it always makes sense to try and reduce your tax burden. There's an article, now obviously taxes, it's not just about what you're paying in, there's a big political quarrel around all of it. So here's an article from CNN Money, Your Tax Breaks in Limbo as Washington Quarrels. We're going into new power with Congress come the beginning of the year. As far as what do people need to know about their taxes? Are they going to be paying more with Republicans taking power? Is that good for the average family? I mean, where do you think we go from here?
Well, I mean, I would tell you that the best economies, the best stock markets are when you have a Congress that's made up of Republicans and you have a Democratic president.
Okay, so there we go.
There you go. So it is historically significantly better than having a Democratic or Republican controlled House and Senate and the same president. So quite frankly, the makeup of our politics right now is very healthy for markets. We're also in great seasonality. December is one of the best months of the year. The market is really hovering around, it's in, like I said, it's in thin air, but you can't fight it when the market is going up. You have a lot of these positive things that are happening. You have, the Senate and the House that were taken over by the Republicans. That's very positive in the end for taxes. Yep. It's very positive to me for the economy. It creates a lot of balance, and hopefully we can get some things done. Probably not this really lame duck term until we get the newbies in January, and that's when I think you'll see things happen.
Well, strategically, we have people watching from home right now. It's December, getting towards the end of the year. What is some tax advice you can provide here in parting?
Probably the biggest thing is making sure that you've done, for business owners, it's a big time to do work with a lot of business owners. You can do a lot of tax planning by investing in pensions. Some of our clients are putting $200,000, $300,000, $400,000 away, believe it or not, and those are all tax deductible. So for business owners, I would say pension plans to look at because you got till 12/31, so you have the last month to do that.
So do it now. Don't wait till April 15th,
Well, you
2015.
can't. You have to do it by December 31st.
Right.
So most people don't think about tax planning until after the first of the year. Tax planning is done. We do it in September, October, November, December. And so for business owners, there's lots of opportunities. For a regular consumer, I would look at, if you have IRAs, can you contribute to Roths? Can you convert to Roths for some tax-free income? Take advantage of losses in your portfolio. If you have losers, you can sell them and do some what's called tax loss harvesting. It's a fancy way of reducing your taxes. But we do all these things for our clients because, as you know, reducing taxes are the best way to increase your yield, basically with no risk, your rate of return. So we're all for reducing taxes.
Well, I mean, a very big takeaway here is this. There's a difference between a CPA and a tax planner. Now, David is a financial advisor. He can help you construct a plan to reduce your tax liability. But the most important thing here is you can't wait until 2015, April 15th, to do this. If you do it now, you can harvest maybe some of those losses. I mean, we don't like losses, but at least you can offset with some reduction in your tax liability. You can maybe make some strategic decisions, put some money in pension, maybe you have something going on with your real estate. So let David take a look at it. He'll offer a second opinion for you. He also has a book that he's giving out now that he co-authored with some other financial analysts and Steve Forbes. Here it is on your screen, successonomics.com, if you want a free copy of David's book and a free financial review. You can see at the bottom of your screen, if you just send a text asking for that free review, we can get that to you. Also, visit reyesplan.com. David, as always, good to have you in here.